Hello, everyone, and welcome to our Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich. We've got Craig Ward in the chat answering questions. We're really excited to have you guys with us here tonight. Sorry, we're a couple minutes late. Just had a couple technical hiccups getting set up, Zoom doing their updates and everything. But we're really glad to be here and glad you're all here too. If this is your first time on, you'll notice that your microphones are muted. That's how we can all hear Jeff and I talk. But there is a Q&A box at the bottom. So if you have any questions throughout the evening, just put those in there and we'll get to those throughout the session and also at the end before we sign off. If you have to hop off for any reason, don't worry, this is recorded and will be available in the members area sometime tonight and also on YouTube over the next day or two. So before I bring on Jeff, let me just read the disclaimer real quick. Altos Trading LLC and TradeTrend Zillion software is intended to be used as an information service for subscribers and includes opinions as to buying, selling, and holding various stocks and other securities. However, publishers of Altos Trading, TradeTrend, Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directly to any particular subscriber or in view of the particular circumstance of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the TradeTrend, Zillion software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. All right, with that being said, let me bring it over to Jeff. Jeff, you there?
Hey, welcome everybody.
Go. Hey, you're muted, Jeff.
Am I?
Yeah, there you go.
Oh, there it is.
There you go. I missed you guys last week.
Like to catch up. I know. Did you get on last week, Richard?
I got on in like the last 10 minutes, and then I realized we were having a hiccup with the email service, so I was on with those folks like an hour after the call trying to get things sorted out for that. But no, I kind of got on the last minute, but just like Craig was holding it down. So
Craig did a nice job. So yeah, welcome back everybody. Hey Mike, Mushy. Looks like we got a good group on tonight. Sorry we're a little bit late. Had a farm, what I would classify as a farm accident.
Yeah, I try to come up with some sort of reason, but yeah.
So I can officially say I've now been peed in the face by a duck. That's all I'm gonna say.
Green Acres is not even close motion. It's like it's like Funny Farm. Like this is like, I wish if he had a camera, you would have won the $100,000 prize on American Funniest Home Videos.
Yeah, I wish. Easy. Actually, you know what? We do have a security system and camera system in the house. Maybe I should review that and see if I got any good footage. All right, I'll tell you guys quickly the backstory. Our cat, we have an indoor-outdoor cat, and he's an avid hunter, and well, likes to bring us gifts from time to time. And I was headed out into the back patio just a little while ago, actually, maybe like a couple hours ago, and he was coming running in with a duck. We live on a river and pond and stuff, so we got a lot of ducks around, and he decided to bring a duck in to the house. So, and it was a baby duck, it was like that big, and I'm like, oh no. So I was able to get him to drop it, but he injured it, and there was blood dripping everywhere, and then of course the duck freaks out and starts pooping and peeing all over the house, and I was trying to keep the cat from getting back. He's trying to go after the duck, and I was like, oh god. My wife was gone, so I was here by myself, and then I'm trying to save the duck and lock the cat in the bathroom. Well, the cat has now learned to open the laundry room door, so it just reaches right up and opens the door handle, and so I locked the cat in the bathroom like 4 times, and it just kept getting out. And one of the times I lost sight of the duck, who at one point ran into the living room and like hid under the couch. And then the 4th time I got the cat in the laundry room, it was gone when I got back, and I was like, so it was in the house somewhere. I couldn't find it, so I spent like half an hour trying to find this little duckling, and it had crawled like way back into a bookshelf thing in our entertainment center. It was hidden back there. I couldn't see it, but finally found it. Thought it was dead. So the punchline is I left it there for a little bit. I want to make sure it's okay. That it wasn't too injured and didn't seem like it was bleeding anymore and stuff. So it was on the very bottom shelf. So I bent down on my, hands and knees and reached back in there to get it. And it's backwards towards me, and I was pulling it out towards my face, and it just sprayed me in the face, just peed all over my face. So that
Poor thing.
that's actually the true technical difficulty of why we're a little bit late tonight.
Yeah.
But I'm okay. And
You
the
made
duck's
it.
okay. I got it back out into the water and it swam off, and hopefully it found its mom. So
See that? It had a happy ending there at the end. It got
all's well.
out, it got free.
Yeah, all's well that ends well. So John said, yikes. Oh my goodness. Yeah, I think the duck is okay. It didn't seem to be bleeding anymore, so it swam
I saw
off.
someone that said the cat wanted a Peking duck for dinner.
The sad part of the story, though, actually, is I got the cat back outside, and just right before we started up tonight, it came back with a bird, and that bird did not survive. Normally, it doesn't go on hunting rampages to that extreme, but we think it's because we didn't give the cat its wet food. It likes Fancy Feast, and it didn't get its Fancy Feast at lunch, so it's probably our fault.
Yeah, I'm telling you, man. Cats are mean.
Yeah, I just tell myself it's instinctual. It's their instinct, right, to hunt. So,
There you go.
but our instinct is to trade. So let's get
That's
get
right.
over to that. Thanks for listening, and
That's right.
I'm all cleaned up now. So,
That's right.
all
Let's
right.
take down some profits now.
Yes, we'll make up for it. All right. So we'll map out our levels. The 36-month moving average is really playing out nicely, as we've talked about over the past weeks. And
Yeah, you totally called it.
yeah, I had a feeling in July, all the buying that was coming in off that level was pretty convincing. And the hedge funds have to release their position holdings once a quarter. It's called a 13F filing. So they reveal like their holdings for the previous quarter. So this would have been for Q2 this year. So that came out, I think today or yesterday. And it's interesting to see kind of like what some of the big funds have been buying and things, a lot of energy and oil and stuff like that. Utilities, I think. So a lot of energy type stuff. But there is a lot of buying going on, and more short covering from all the shorts that were in place from earlier in the year. So I think, that along with other institutional buying has really pushed prices higher. And as we have talked about on our weekly sessions and looked at with the 36-month moving average, that's a very common area for big funds to come in and buy during market sell-offs or bear markets. So it's why we focus so much on it, and we'll continue to follow up. And we're mostly going to spend time looking at stuff because we are in a market rebound right now. I wouldn't classify this as a bear market rally anymore. This is a pretty, sustained or convincing rebound that I think has some sustainability. We have still quite a ways to go, to close the year on a positive note, which I think is less likely. But at least from the lows that we saw, back April, May, we seem to be far enough off those now. I'd be surprised if we get back down to those there's really no big catalyst. I mean, right now we're looking at earnings again, but without something to really drive that. Inflation seems to have peaked, and that is also what has resulted in a lot of this market rebound was the July CPI report. So consumer price index, indicated that there was actually not an increase in inflation in July. It doesn't mean that inflation is still at high levels, but that's the first promising sign that we are starting to reverse course and turn things back around. And it also might mean that there's not as much need for aggressive Fed tightening in the coming FOMC meetings. So those are just high level, some of the things that are causing this market rebound. So because things are starting to, turn around and we're in a good uptrend, I think it's a good opportunity to look at things that you guys might be interested in. So we're going to dedicate this week to Ticker Roundtable and any strategy that you guys might want to talk about as well. So let's go ahead and get over to charting. My video. Where'd you go? There it is. All right. So let's take a look at the S&P. And I think it was last week, we talked about 4,200 as resistance, and that if we broke through and started seeing a couple closes above 4,200, that would be a very bullish sign. And then, so that's happened. And that's now going to be our major level of support, near-term support to watch on the S&P. So recall that when a resistance level or zone is broken, it becomes support, and 4,200. We'll create more of a zone out of this, but 4,150 to 4,200. And then I'm also watching, just because there was a very wide range candle from back in, I think, late January, early February, after that first leg of the sell-off, that I'm drawing the line here. So these are all kind of really levels of support or support zone that we're watching. And as long as we can stay above this, I think that indicates some pretty strong bullishness in the market. Also to note is that we have transitioned from this red divergence cloud, which in the last one occurred back in mid-March, and then we transitioned into a green one in July as the market formed this double bottom in July. And so now we're in a green divergence cloud, which is bullish. So for resistance, 4,300. Now we closed above 4,300 on the S&P today, but not by much, by a little over 5 points. And you'll notice that there's some rejection at this 4,300 level. Okay, so we previously had moved up into it and sold off, moved up into it and sold off. It served as support back in January, February. I guess more January, and moved up off of it. So 4,300 is, we may see some stalling here, especially after a strong up move, which is fine. You know, markets can't move in straight lines. So this might be an inflection point to keep an eye on at 4,300, and we may see a pullback into the 4225 to 4,200 level. But as long as we stay above, really above 4,200, and definitely above 4,150, just because we had some upward price rejection and then sell off from that level. If we can stay above this support zone that I've indicated here, it might be a good buying opportunity for a continuation of the uptrend at slightly lower prices. I've stopped buying. I've legged into positions on the SPY, SPY, and the QQQ, and actually even the SPXL, the triple leveraged S&P ETF. So I've built some long positions in those, but down at lower prices. So I've kind of stopped buying at this point. I'm waiting, for potentially a pullback into support to add to any positions. So right now, because we're at a resistance level on the S&P, I'm just waiting for, this is our resistance, to come back into support, for better long buying opportunities on the S&Ps. Okay, so let's see. Let's take a look at the Qs for the NASDAQ. We're seeing some indecision on the NASDAQ today, the QQQ. So you'll see that also transitioned around the same time into a green divergence cloud. So bullish, and we've broken through some resistance, which now serves as support around, kind of right around 320. But we've also got some resistance to contend with around 335. And so we hit that today, and see how we came up on today's candle into that 335 level. See what the actual high was, 334.42. So just right around that 335 level. And then sellers came in, and we ended up closing pretty close to the open, although the open, we gapped up on the open this morning. Let's see here. So there's the prior support. And so this is now a resistance level right around 335. Or sorry, we gapped down. I think I misspoke and said we gapped up. We gapped down on the open, but then closed a little bit higher from where it opened. So there's resistance, and then there's support. So those are the main ones I'm watching for this week on the NASDAQ, QQQ. So if we can break through 335, again, I'm right now just holding on to some long positions in the Qs, but if I can break through 335 and get a couple closes above that level, then I would wait for a retest down into that, what was resistance, and would become support if we get a breakthrough, to potentially look at adding it into long positions there. But even, a rejection of this 335 level back down into support around 320 could create, some good buying opportunities, because we've got historically, strong support at this 320 level with big moves up off that level. So there was past buying there, even in the midst of, the bear market from, February, March earlier this year. We did sell quite a bit below there. So, if we break 320, then I'm going to be watching kind of the half centuries, 315, right around 307. But those may, probably unlikely to hit those this week or before our session next Tuesday. So those are the major levels on the Qs. And of course, the VIX has retreated dramatically. And pull up the chart here. We got a close below 20. So this hasn't happened in a long time. And so remember, guys, what I've really emphasized over the past months, as we're seeing the VIX come down off resistance, and the majors, the S&P, the NASDAQ breaking resistance levels to the upside, and then the VIX retreating, dip back down off of resistance. That's the confluence that we look for any sort of earlier on in the year was a bear market rally, but now I would classify this as an actual market rebound. A little bit cautious to say that while we may be out of a technical bear market in some cases, that until we see inflation really come down some and see what happens as far as recessionary fears and things, that we're completely out. But there's something also to note here. So this is why we use the VIX. So, we're so, actually, let me clear these out. It's such an important tool for us to analyze. So we saw that on the QQQ and the S&P, we're at resistance levels. So where are we on the VIX? We're near a support level. So this is a very simple, quick way to gauge, like, is now a good time to really buy into the rally? Well, I would say no. It's the good time to buy in the rally would be when the VIX is hitting resistance and the S&P and the NASDAQ are breaking through resistance levels at lower levels and then finding support at those prior resistance levels. Those are the good times to buy in. That's when hedge funds and big institutions are buying into the markets. Right now, we may start to see some selling because now the VIX is at a support level and the majors, the S&P and the NASDAQ, are at resistance levels. So all this really means to me is that we might see some stalling in the upward movement over the rest of the week. Maybe not. If we see, so that's why keep a close eye on this 19 level, and also whether we stay below 20. Okay, 20 is a really key number to watch on the VIX. We sort of bottomed here around 19, which was 18 and 19 were lows from back in March and April. So if we break 19, so here's what I'm looking for for confirmation of a continuation of the uptrend. The VIX breaking this support level at 19, and the S&P and NASDAQ breaking the resistance levels that we just mapped out. If we get a big VIX bounce off this 19 to 20 support zone back up, and the S&P and NASDAQ sell off from those resistance zones, then that could be just a bit of a retracement or correction, like small correction in the context of this broader uptrend. But until we see kind of what happens around this support zone on the VIX and the resistance levels on the S&P and NASDAQ, we won't know really for sure. But this is all very near-term stuff. We're just really looking at, this is all happening right now today, August 16th, and we're really looking at what's happening for the rest of this week. So now's a really important time to kind of be monitoring these levels as we're trending up in the markets. Because you don't want to buy when, right at a top when things are about to, there might be some profit taking or even short sellers coming in that might push prices back down a little bit. And that doesn't mean the market's going to crash necessarily. It just means that there might be some profit taking and some minor short selling that would, drive prices lower, but that can be a good thing because then it creates buying opportunities, right, at lower prices. So last thing we'll look at real quick here, and then we'll open it up, is our 36-month moving average. So this is all really working out very nicely. And we started looking at this, I think back in like May or June. We started really talking about this so this is a monthly chart of the S&P. So each candle represents a month worth of trading. And we've got a 36 period moving average. So of course, on a monthly chart, we're looking at a 36-month moving average. So why do we use a 36-month moving average? Because there's rationale behind it, and it's basically related to the cyclic, how cyclical bull and bear markets work in terms of time. So it tends to be a very reliable average or area of pullback within bull markets, but also even when we enter bear market territory for buying opportunities. And you can see that it doesn't work 100% of the time, but you can see that historically it can create some really opportune buying opportunities. And I think, opportune entry prices. And I think that that's happened, really June, July of this year, after this sell-off from, the peak back in December, January. So this actually, we got very far away from the mean. And basically, and this is referred to as mean reversion. So any average that you use, that you map on your charts and use against an asset, in its price as it relates to the mean, it will either be moving away from the mean, or it will be what's called mean reverting, moving back towards the mean. And over the very, very long term, you'll see this 36-month moving average on the major indices, the S&P and the NASDAQ and the Russell, in a pretty nice, well-defined uptrend, right? Because the markets have an upward trending bias over the long term. So that's why, and I think on past sessions, some of our members have asked, do I use 36 period moving average like on individual stocks or other things? And yeah, it can be used on those, but really for me, it's kind of I really mainly use it on the major indices like the S&P and the NASDAQ, especially what I'm going to buy like an index product like the SPY or the Qs. It can be really nice, work really nicely for that. And this is kind of where I started building positions in my own personal portfolio based on this 36-month moving average and what the VIX was doing at the time. So, I saw retreating VIX, as we just looked at on the chart over the last couple months, right? The VIX hit that 35 to 37 resistance zone and started to retreat back down. And the S&P mean reverted into the 36-month moving average, and then found some, and a real clue is in June. So even though this was a bearish candle, you'll see that price came down and even traded below the 36-month moving average, but there were buyers that came in and closed the price back above the 36-month moving average. So, most people would look at this candle right here and be like, wow, that was really bad. It was a bearish candle. I actually looked at it as, wow, that was really good. There was a wide range candle. So, our ranges were like 3,700 to 4,200 on the S&P. It's a very wide range for the month, with a very strong bearish close, with an open near the high and a close relatively close to the low. But the hidden thing to see here is that there were actually buyers coming in as the S&P mean reverted, and then enough of them came in at this level that they were able to close price above. And as I pointed out in past weeks, let me clear this so you can see it. This looks very similar to back here in late 2018. And we actually dipped into bear market territory, I think, on the NASDAQ here. But see how similar this candle looks right at the 36-month moving average. And then the next month's candle, so this would have been January, looks very similar to this. See how close that looks? The third month candle after this mean reversion didn't really get much above this candle. We're way above this candle now. So this is looking even more bullish than it did back here in early 2019. We didn't get 2019 was a good year, but then, COVID hit, obviously, and we get this market crash in 2020. So we didn't get really all that far before we mean reverted again. And this one we did close significantly off the lows, but here the buying opportunity was in April, because this was deemed as, attractive buying prices on the majors. And there was you can see by the price action, a lot of buyers came in below the 36-month moving average, closed it back above. And then we really took off in a parabolic uptrend before, of course, this year. Really great tool, I think, for if you're more of a buy and hold investor. But not even just that. Even if you trade and you're intraday trading, it may not serve you for as long a period of time. Like this was really much more relevant back in June and July if you're like doing very short-term intraday or swing trading. But it's still, even if you're not like buying and holding something, it's still really good information to have, because it can help, obviously, drill down in your decision-making process for shorter term trades as well, not just for, longer term. But yeah, so 4,200. So, the big question is, are we going to get back up above previous all-time highs this year? I think unlikely, but we could get up, quite a bit higher from where we are right now. And so what I'd be looking at on the S&P is 4,600. Because see all this rejection right here? So even in this bullish candle, where buyers drove price above 4,600, bears came in and closed below. So this is not a bullish candle to me. It's a bearish candle, and it's sandwiched by two big bearish candles, one of which broke 4,200. So 4,600 is more of a medium to longer term resistance we're going to be watching very closely on the S&P. I think we have a good chance of getting back up there, but if we do this year, we're going to encounter some resistance there. You can mark my word on that. We're not just going to blow through 4,600. So I think, even if we do get through it, then we've got 4,800 to contend with. So I think it's very valuable, even if you're trading off shorter term timeframes, to even go out to monthly charts like this and look at the monthly charts and get a really, high level overview and bigger picture of what's happening in the markets, because it can really clear things up for you, I think. Himanshu, the monthly trend and 36-month moving average built in the trade trend. Actually, Himanshu, it's not. We don't build the 36 period moving average into the trade trend indicator. So interestingly, and you probably noticed, which led you to ask the question, is you might see on like the monthly chart, you're getting some buy signals around this. It's actually somewhat coincidental. So it's not actually built in, but some of the other algorithms and methodologies built into the trade trend indicator are built in such a way that it's not really surprising that we would see buy signals closer to a mean or an average, which is also not really the algorithm. It doesn't issue signals at moving averages either. So it doesn't actually use a moving average by itself. So somewhat coincidental, Himanshu, but good question. And definitely, if you can find buy signals, even if they're on higher time frame charts like the monthlies, or the weeklies or the dailies, near major moving averages, those can be great opportunities as well. We actually haven't received a buy signal on the monthly time frame yet from TradeTrend, but this is where you could drill down in a smaller time frame. So as we're retreating down into the 36-month moving average and then bouncing off of it, we could then go down into a daily time frame, or a weekly or a daily, and see were there any buy signals around that level. And there were some buy signals down here back in June and July on the daily time frame. So I think it's also helpful, and good question, and glad you asked that, Himanshu, because I think it's also helpful to look at the higher time frames and see where those signals come in on the higher time frames, before you maybe look at a lower time frame signal. All right. Looks like there's been some questions and things come in. I just happened to catch some answers out of the corner of my eye. But Richard, are there any other questions before we move on?
Let's see. Ray's wondering, he asked a little bit earlier, in your opinion, does the third or fourth, say, mean reversion typically signify a probable down move?
Not necessarily. Let's zoom out, let's go back 20 years. So back in like the .com bubble, so early 2000s, we dipped below the 36-month moving average on the S&P, spent a little bit more time below it before getting above it. So that was an actual failure of the 36-month moving average to some degree, but that's okay. And it happened again in 08 in the housing crisis. These are very significant market declines. I mean, in 08, the market lost over 50% of its value in the second half of the year. So much more than it's lost in the first half of this year. It was a more significant sell-off, peak to trough on a percentage basis. So what we look for, if we get dips below 36 month, is it requires patience, unless you're going to short sell or use bearish strategies, for the S&P to come and close back above the 36 month, and that usually leads to some very nice rebounds, as you've seen here. But it's kind of hard to say. I mean, like on a number basis, how often it will fail, or I wouldn't necessarily look at it that way. I mean, so after the 08 rebound, or the 08 market crash, and then the rebound, there was a mean reversion. That was a bit of a mean reversion, but didn't really come back down into it. This was a mean reversion, mean reversion, mean reversion, mean reversion, mean reversion. So that's a lot. I mean, since the 08 housing crash, we have 1, 2, 3, 4, 5. This is like the 6th one. and they've held, pretty well. And then, you might see some that dip below. Generally, like with that, if you get more than a 50% peak to trough sell-off, so if you hit a high on the market, then we go in from a bull market to a bear market, like in dot-com bubble or the '08 housing crash, and the market loses more than 50% of its value, that's generally going to, unless you're really way above the 36-month moving average, which is unlikely, you're generally going to dip below. So those are going to be, market circumstances where we need to, potentially use bearish strategies or short selling, and or wait for, the market to recover and close back above the 36-month moving average. But we have, even in the midst of this bear market, in the highest inflation we've seen in 40 years, and the COVID pandemic and all of these major geopolitical things, the Russia-Ukraine war, all these crazy things that are going on right now, we still did not close below the 36-month moving average since all of that stuff has really happened. So back here we did, but this is with the start of COVID, right? So since that, and we've had all these things that I just mentioned, we haven't closed below it. But we went into bear market territory. But always look at things as on a moving basis, right? So back when COVID hit, and then the market recovered, it crashed and then recovered, and we went on this incredible, bull market run. Look at the levels that we were at that time, right? So this is when the market was, the S&P was around 3,400 at an all-time high at the start of 2020 before the COVID crash, right? So we're in this kind of zone here, and all of this stuff is still going on, and more, Russia-Ukraine war, and then inflation, and we're still, the S&P is still trading above where it was back when it was just COVID. So kind of look at, and that's why we use peak to trough, and you'll see, and that's what really at the very, I think, basis of all this is, and why you see these major rebounds, even in the midst of like these major geopolitical things that you would expect to really do long-term damage to the markets, is why you see the buying and stuff after these events, is because hedge funds and institutions are watching peak to trough levels. So so up around 4,800, all-time high in the S&P is 48,1862. So there had to be buyers, let's just say at 4,800, to be able to get up to 48,1862. Nobody bought above 48,1862. We know that for sure. There were no buyers above that price. The price never got up there. Okay, so there's no buyers up beyond this level. No buyers. There were a lot of sellers right here around 4,800. Okay, so we marked that as a peak. And then as markets sell off, we're looking for, and it's always a moving number, right? Because markets prices are changing all the time. We're looking for the trough. Like, what is the difference between the peak price and the trough price? And it's really regardless of what the prices were in the past. People were saying that the S&P was overpriced and overvalued down here. They were saying it right here. They were saying it right here. They were saying it right here. They were saying it here. People will continue to say things are overvalued, but as long as somebody's buying at a price level, it really doesn't matter. People, if there are buyers, it's going to push the price up. If they're sellers, it's going to push the price down. So that's why we advocate, be a buyer at lower prices and a seller at higher prices. Versus, you don't want to buy when the number of buyers is dwindling and running out. You want to buy when there's too many sellers, right? The whole supply demand curve. So that's why we see mean reversion and then buying off of these major averages. So it's somewhat of a self-fulfilling prophecy, but hedge funds and institutions are buying at these troughs, and we've gone over that in past sessions, how to use peak to trough percentages. I mean, you can in my opinion, if you just want to buy index products like the SPY or the Qs or the Russell, you could throw all of your indicators out the window and just use peak to trough percentages and scale in and use really good money management, and you'll probably do very well over the long term. So we've covered that in past weekly sessions, how to use like, a 5%, a 10%, 15, a 20, 25, 30, and so on and so forth, percent peak to trough to identify potential buying points. But it does help if you can spot those buying, those percentage peak to trough percentage buying levels with, like, for instance, the 36-month moving average or a trade trend buy signal. So we still want to look for confluence and then also using the VIX.
Awesome. Let's see. Chris asks, is it time for the risk reversal trade yet?
Oh, good question. Yeah, we should revisit risk reversals. I think it's starting to make more sense. Anytime the S&P dips below, or sorry, the VIX dips below 20, and especially if it's at a support level, as we looked at. So let me get back over to that real quick. It can start to make more sense. Really though, the most opportune place for a risk reversal on the VIX is going to be at lower levels, like 16, ideally like 16 or 15 or less. So probably not quite there, unless you have the ability to take on more risk with selling the puts. Because if the VIX does end up retreating even more, and I think it has a better chance now with this market rebound, I'm not putting on any risk reversals right now on the VIX, because I think the probability of it moving down into these lower levels is too high, which would hurt the risk reversal trade. But if you have the ability to ride it out and roll your puts and do some different things, it's not out of the question. But I prefer it to be, for the risk reversal, to be more in this zone down here. So, like, we can find support here from past levels. And you can also be kind of strategic with it. Like if you see the VIX bouncing off a level, that you could put on a little risk reversal trade there as well. But one thing you can do, like, is just you could do like a call spread on the VIX, also as a hedge or speculation around support levels. So and what we look for that is a buy signal at or below 20. So like this was a good one. And then I go 30 to 45 days out and do a call spread at the money call spread. So here's a good one down here. So we don't have a buy signal yet. Now that we're below 20, we haven't gotten the buy signal. So what I would do is wait. TradeTrend is very good with buy signals on the VIX below 20. So see, we had 3 of them here. And then we get these big spikes. And then there's this one big spike. And then I ignore these buys. I ignore the ones above the 20 level because the VIX is already spiked. So I want to see them below 20. So we don't have one yet. But when you get a buy signal below 20, and that's kind of what I'm watching for right now on the VIX daily chart, I might go over and set up like a call spread. So I'd buy a vertical debit spread of calls on the VIX as a hedge, against any long positions on my portfolio. Yeah, Keith, you can use risk reversal on really any optionable stock, Microsoft, Apple, Amazon, Tesla. Yeah. It's I find it works particularly well on volatile stocks, because the problem you run into with just buying straight options on volatile stocks is the premium is usually way overpriced because of the volatility. Because implied volatility is really the largest component that factors into option pricing. So when you get volatile stocks like Amazon or Tesla, you'll often find, like, if you want to take a directional option strategy on those, the premium is going to be very high. They're going to be very expensive. So, if you want to take a bullish directional options play on one of those stocks, sometimes a risk reversal can be a way to do it. Or if, at the very least, if you're not doing a risk reversal, you can do at least do a call spread. What vertical call debit spreads do is they help kind of dampen that implied volatility or volatility crush. Because what you'll often see happen, like with a stock like Amazon or Tesla, is if you just buy a call, even if the stock goes up like you expected it, you might not make any, or you could even lose money on that straight call purchase. And that's because of volatility crush. Because as the price of the asset moves up, the implied volatility goes down, which negatively impacts the premium of the option. And if you're an option buyer, that'll be harmful to you. So the way to overcome that, one is with a risk reversal, and that's the risk reversal is a more aggressive way, to overcome that volatility crush. But you can also overcome the volatility crush with just a vertical call debit spread. Just buy a call and sell it further out of the money call, and you'll still you'll have a better chance of making money on a move up in the stock than you will if you just buy the straight call. Because if you take trader A just buys a call on Tesla and Tesla goes up, and trader B buys a vertical call debit spread on Tesla with the same long strike as trader A, but then also sells an equal number of contracts at a higher strike and sets up a vertical call debit spread, trader B has a much higher probability of profit than trader A.
Let's see. You've covered this in the past, but Boris is wondering if you're applying the Fibonacci to, let's say, the S&P, seeing if it pulls back to 62.8%, then that would be a point for it to turn around and go back south. Do you use Fibonacci in your assessment?
I don't use Fibonacci a whole lot. I mean, not to say I never have, but the Fibonacci is a bit more of an advanced tool. We can do a session on it, down the road if you guys would like to. But kind of the thing with Fibonacci for me is, let me actually get over to, is there's some degree of subjectivity to it. In fact, there's a pretty significant degree of subjectivity to it. Where do you start and where do you stop? So like if one person, if one person picks point A for their starting point and draws a, Fibonacci, but then let's say, another person picks a different level and starts it, and then, another person picks a different level. And so there's a lot of subjectivity, to it. So if you do it, I think it's important to obviously try to pick major levels, for a starting point of drawing your fib levels that you think other people would be selecting and looking at. And oftentimes, people that use Fibonacci a lot and are experienced with drawing them and stuff, and analyzing them, tend to find, pretty nice buying and selling levels with those. But I've never really gotten, into them enough and used them enough to really find the reliability that I do with some other methods and tools. So I don't use fib levels a lot, but they're also very heavily, time frame dependent. So, I think if you're using fib levels, it's good to, do them on on multiple time frames, like on a daily chart. If you're intraday trading, a daily chart, 4-hour chart, 1-hour chart, or if you're trading longer term daily charts, weekly and monthly fib levels, I think are important. But yeah, that's kind of really all I can comment. I mean, we could might be nice to down the road, sometime probably this quarter, if not next, we plan on having guest educators on, because not everybody knows everything, and I certainly don't know everything, and there's things I'm not as experienced with, and Fibonacci is one of those. So probably once a month or so, we'll be having a guest educator on who can, cover different things that I might not be covering. So you guys get more value beyond just what I'm able to provide here on our weekly sessions. And so we'll likely have Josh from Traders Agency on over, because he's very experienced with Fibonacci and uses it a lot. So maybe that's something we could look at doing here in the next month or so.
All right. That's more of a comment. Mantrice just wanted to say thanks to Jeff creating the culture of looking at indices and the VIX. Say he needs to have that more ingrained in his thinking, and more sessions on risk reversal will really help in the future.
Awesome. Yeah, we'll definitely do more sessions on risk reversal, especially if the VIX gets lower. Like if we break through some of these resistance levels and we get lower VIX, when it really makes it's very, very opportune to get into a risk reversal on the VIX, we'll definitely hit that, and we'll look at setting one up. And I'll probably even put a live one on my personal trading account for you guys, show you how I do it. And yeah, thank you for the kind words. You're welcome. And the reason that we run through all this is number one, and I'm trying to give you guys tools and methodologies that are beyond the retail trading world, that are used in hedge funds and big institutions and things that you might not kind of see in the regular retail trading and investing world. And also just like personally, this is where things I think started to really click for me when I kind of went from being more of a novice and beginner trader to being more successful and consistent, was when I really started to use this top-down analysis approach and looking at the major indices. So even if I'm trading stocks or futures, or I spent a decent amount of time trading forex directly through Citibank. Did that for like, I don't know, 4 or 5 years. I still did all of this, and that's where it really started to click for me, was when I started looking at using a top-down approach, looking at the higher time frames. And then, whereas in the beginning, I kind of ignored it. And I just really was too focused on what I was trading, whether it was a time frame or an asset. So I think if you can kind of broaden your horizon, look at higher time frames, longer moving averages, and the 50 and the 200, for instance, are longer term moving averages that are widely, closely watched in the institutional world. And then, and then cross asset analysis is also really good. Like, so, even if you're trading, a NASDAQ 100 stock, it's helpful to look at the S&Ps, and it's helpful to look at the Russell and kind of know, because there's all this cross correlation that occurs in markets. And it's, if you can kind of broaden the horizon there and look at a lot of different things without getting, you don't want to overcomplicate it. But if you can do that, I think it'll, for me, it made a big difference. And that's why I present everything this way, because I don't want it, to click for you guys. And I think, it's one thing to see me do it, and hopefully that's helpful, but ultimately, you'll want to do it on your own, use this approach on your own and walk through it. And then as you continue to do it more and more, it just becomes, second nature.
Awesome.
Thanks, Ray. Yeah. Ray, also, the VIX is, I'm glad to hear that's helping you. The VIX is also another thing that, I mean, believe it or not, I used to never even look at the VIX, and I was like, well, whatever the VIX does, market's volatile, it's not, then I'm just going to do my strategy. Then I started using the VIX, and that was a major light bulb moment for me. It's like, all this time have not even been considering the VIX. I mean, you hear about it. Yeah, the VIX is at this level, so what? But when I started using it to actually, time the major indices and use it to gauge volatility and stuff, it made a huge difference. There's actually, on the CBOE website, there's I think if you just Google VIX, CBOE VIX, they have a whole page, the CBOE, Chicago Board Options Exchange, that, that covers the VIX. They have a whole page just for the VIX, and there's some really interesting white papers on there you guys might want to check out. And you can read kind of about you can get really in depth and really read a lot of crazy stuff on the VIX and how to analyze it, which a lot of it's probably beyond the scope of what we would need as retail traders. But I think would be really helpful. So if you guys ever are interested in learning more about the VIX, the CBOE website has some really good videos, and also white papers that they've published from their, the board members and stuff that use the VIX, and even some of them who help create the VIX product, that can really give some nice background on it, on, how the accuracy is with, forecasting volatility and price movements and all this stuff. So pretty cool.
Awesome. That's all I got question-wise.
Yeah. So if you guys want to take a look at any tickers, you can feel free to type those in the chat box. We can take a look at some individual stocks or ETFs or futures or whatever you guys might want to look at. If you want to put those in the chat or the Q&A, be happy to take a look at anything you guys are watching right now.
Let's see.
Maybe Richard or
People are
Craig.
being shy. We're gonna get 10 at once. There you go.
Okay, we got Target,
Here's got Target. Yep.
the retail. To Target, I think Keith put that in. Did Target come out with earnings today? I think this is like a pretty big retail earnings week. The stock traded way up today. So watch this resistance level.
He says tomorrow morning.
It's tomorrow morning. Okay. So this is good to watch then. QE coming out tomorrow morning. We've had a big run up from around the 140 support, but we did trade into resistance. So see how today, we obviously had a big gap up on the morning, and then buyers still from the open drove price up into around the 185 level, but then see how sellers came in, and we kind of closed midway through the range today. But that's the significance of that is look at what happened at this 185 level, which was prior support, right? So we got a lot of buying off that. So this is actually good information. So it's now at the current time a resistance level. So right now this is resistance. Back here it was support. But the reason that's good information, especially around an earnings release, is if we can break through this off on earnings tomorrow and close above it at the end of the day. So if earnings releases in the morning tomorrow, I'd watch for false breakouts. So even if the stock moves up, it's very common to get false reversals or breakouts on quarterly earnings. So if you see a close strongly above this 185 level, well, there was a lot of buying interests around that price back in late February, and so if we can break through and close above 185, and then maybe even get a bit of a retest down in to give us confirmation that this will hold as support, that could create some potentially nice buying opportunities on Target. Because previously the stock ran up from 185 up into around the 250, 260 level. So that's a big percentage, move and an opportunity. But it'll be interesting to see, how does the stock react? We did get a buy signal. There is an open buy on Target. So entry been probably right around the 173 level roughly. So there's an open buy, trailing stop down here. But again, with earnings coming out in the morning, if I were in this a trade off this buy signal, I would have taken profits today, just because earnings can be unpredictable, obviously. So that's a good one. And then I think, was it Ross? Ross was the other one.
Yeah, we got a bunch of them.
A lot came in. Okay, we'll do our best. We'll kind of move through quickly. It's probably because there's just a lot of earnings coming out this week. But probably same thing with Ross. Yeah. This one's broken through more resistance. So I'd be watching, 80, around 86 to 87 for strong support, and around 98 for strong resistance on Ross. But also big parabolic move up. So there is an open buy signal. Had a couple really nice buy signals on this run up over the last couple of months on TradeTrend. Got another one for me, Richard?
Yeah, Merck, MRK.
So I'm a little bearish on Merck right now. Some of these pharma stocks have run into some trouble recently. really strong resistance around 95, 92, 91. So we've got a lot of overhead resistance going on right now. So it looks like over the past few trading days, this 91 level has been difficult for the stock to break through. Also, we've seen a lot of selling around this level in the past. So to me, that flashes caution that these resistance levels may be a bit difficult for the stock to get through. But generally, the more difficult the resistance level, if it can be broken and sustained, can also lead to bigger run up in the stock. But overall, Merck is really in a trading range right now. So anytime a stock is in a range, I try to avoid obviously buying near the high of the range. So here's kind of the low of the range. See where I found this support, prior resistance. So if I'm going to play a ranging stock, which is to me what Merck is right now, I want to look at profit taking near the high of the range, or short selling, or bearish option strategies. And I want to look at bullish option strategies, or buying, or, with other confluence of other factors and variables near the bottom of the range. So right now this is, has more, I think, chance of a move to the lower end of the range at this point.
All right, GEO.
Familiar with that one, the Geo Group.
I think it's a REIT.
Oh, okay. Interesting price action. Kind of choppy. Big moves. So there was a buy yesterday. Yes, it looks like Geo moved up into this resistance level or zone and sold off from there. So short term, I'm watching like the 8 to 820 zone. Resistance, support, resistance, support, support. And then, and obviously the stock moved up today, but closed lower off the high. So the support, the most obvious support level is right around 750. And interestingly, the stock kind of came down into that level today. And so see how you have prior resistance here. So this is an interesting one to kind of monitor to see, because we've got both support and resistance that were, played with today, all in today's trading. So this is the resistance zone, and this is support. So my analysis would be, if we can get above 840, then it has more room to run up. If this support level down around 750 breaks, then we're back in this prior range, with the low of the range kind of right around 6. So we got to, and it broke out of this kind of really yesterday, today, this week. So we'll see. This is one I'd watch for a false break out of the range, or did it move up into what it will create as a new range with the new support and resistance levels that I just mapped out. Not real familiar with the name. I don't trade a whole lot of REITs, but have in the past, but just not familiar with this one.
Let's see. I got a request for lows.
My second favorite store to Home Depot. Actually, I like Lowe's better for some things. But Home Depot is right by our house, which is not good. In fact, my wife just went there today, and we went there yesterday together. We go there
I live
like
in Atlanta, so like you gotta go to Home Depot.
oh
Uh,
yeah, there
yeah.
you go. Yeah, I'm a big Home Depot fan. Although I don't think I've ever bought the stock. Traded options around it.
If I'm in a
All right.
hurry, I go to Lowe's.
Why is that?
You just get in and out of there so much faster than Home Depot to me.
Oh, interesting.
Yeah.
Yeah, so this one's looking good. So strong close today above a resistance level. So this is resistance. We're also in a green divergence cloud, and we've got an open buy signal with trailing stop right there. Entry was about right there. So this one's already run up, like 14 points from the last buy signal in the green cloud. So this is a good signal. So this is resistance, and you can see how strong this resistance level was. Prior support. So I'm finding both support and resistance at right around this, what is it, like 209, 209.50. Broke through it today, somewhere of a zone, like 209 to 210, let's say. So this is looking pretty bullish. So as this stock runs up, we want to be looking for any significant levels of resistance, which I'm seeing kind of around 220 to 2. And see, this is from back. This level even goes further back that I drew here. So this like 209.50 level, 209 to 210 is very, very strong support. Prior resistance. So this is very bullish that we got such a strong close above it today. So I think, this one potentially has room to run up still. But I think they'll, encounter some resistance as we get up into 220 or higher if the stock makes it up there this week. And then keep in mind too, it has had a really big run since the lows from June and July off around 172, 170, 172. And so it's made a big run up already. So anytime that happens, there's always a bigger chance for a pullback. But even if we get a pullback into this roughly 209.50 level, that could even create buying opportunities as long as it holds and give maybe a better long entry opportunity down, 5 or so points below where price is currently trading. So yeah, looking good on that one. Oh, and Keith says Lowe's has earnings tomorrow morning. All right. And with earnings, like a lot of times with retailers, earnings can be seasonal. So sometimes it helps to look at past earnings releases at the same time of the year from the prior year. So you could look at, the earnings that came out that probably sometime in August, possibly July in 2021, and see how the stock reacted. It's not a guarantee, obviously, but sometimes it can help. I often look at that if I'm going to do an earnings play or trade around earnings, kind of see how it reacted in past years in the same quarter. So that, you can see if there's any seasonality effect there. Because oftentimes you'll see like a stock responds well to quarterly earnings on a particular quarter in like a higher percentage of years going back, however many years. So might be the case with Lowe's, and certainly seasonality wise, Lowe's and Home Depot and some of the home retailers tend to do, well in the spring and summer months. So it'd be interesting to look at that too.
How about GDX?
Okay, yeah, let's take a look at GDX. So GDX was really and this is the gold miner ETF. Really in a range for a really long time, with the high around 41 and the low around 29 to 30. And in June, it broke out of that range to the downside. So generally, when you have such a strong range in place, and then a strong break outside of the range, whether it's up or down, it's very common to get a retest, and I think that's kind of what's occurring now, of the side of the range that it broke out from. So I expect we'll probably see GDX, rebound up into this part of the range, and could, eventually return back into the range and use that again as support. We often see that with like metal ETFs and stuff, is they'll be in these ranges for long periods of time, and then they'll break out, but then they'll re-enter the range and go right back into that pattern, because it happened here too. Break out, then it comes back in, and it starts reacting to those support and resistance levels again. So definitely in a range, and I think, let me see if I can zoom out a little bit more, just see, because right now I'm not seeing any real support. So what we want to do is look for these inflection points for past support and resistance, right? And right now there seems to be some right here. Yeah, so right around 2650. This is going back a couple years. But you'll notice that there was some very strong support here that was broken, and you'll see GDX will do this from time to time. This was the COVID crash. Make these strong directional moves and then reverse course very strongly. So see how we got back up through that, what was prior support then became resistance, and had a big run up. So we're kind of back down at these levels that we were seeing from back in late 2019, Q3, Q4 2019. And historically, we've GDX has attracted enough buying to really push prices up back into the 40s, even the high 40s. And so we're kind of back down in those levels. So I suspect that, GDX has probably experienced a lot of the selling that it's going to in the near to medium term and even longer term. It has a good chance for a rebound back up into prior resistance levels into the 30s or even 40s. All right, let's take one more.
Got a couple votes for NVIDIA.
Okay. I'm guessing this is another earnings. Maybe not. Yeah, and NVIDIA is a great company. The stock has really gotten pummeled with the bear market this year. But fundamentally, I think NVIDIA is a great company. And these can be, I think, attractive buys when, they get taken down with the broader markets. And we've certainly seen, you can see, this zone that I've marked here, between the 140 and 150 level, historically got, a lot of buying interest down in this area. And, the stock more than doubled, I mean. And so we're kind of back down in these levels. We're starting to get some buy signals from TradeTrend. But I think, it's kind of in that attractive buying zone, but it's got some resistance to break through, namely like 200. So I really want to see the stock get through 200. You'll see there was an inflection point there that drove a lot of buying. There was a selling into that 200 level. And then 210 also has got Some pretty significant price action around it. So right now, yeah, 200 is really, if there is upcoming earnings this week, I'd really want to see the stock break through 200 and close above it. And if it's selling off from this resistance area that it's currently in, there might be more attractive buying opportunities if we get a retreat back down into this support zone. So I think this is a really nice support zone for buying, if it does come back down, or if this resistance zone is broken. Although we prefer to buy at lower prices, right? Sometimes these strong resistance zones, because it's still peak to trough, a relatively low price. Again, the stock was trading up near 350 towards the end of last year. So people were buying, up above 300. And the stock above 210, I think is still a good, if we can get above that resistance zone, might create some buying opportunities as well. Okay, thanks, Keith. Yeah, NVIDIA has earnings next Wednesday, August 24th. All right. Well, thanks for sharing all those great suggestions, guys. Those are fun ones to look at. So let's go ahead and wrap up with any remaining questions, if there are any.
No, I think you kind of covered it today. Looking through, I don't see anything else that looks like. Nope, I think you did.
All right, thanks, guys. Yeah, thanks, Keith. Appreciate it. Good to see all you guys on. Jerry and Eric, Ray, Michelle. Let's see, is it? Yeah, Ray, Michael, Eric, James, Michelle. Good to see you on. A lot of familiar names. Hope you guys have a great rest of the week. Shoot us an email, support@altostrading.com if you guys have any questions before next Tuesday. Otherwise, we will plan on seeing you back here, same time, same place, next Tuesday.